Yo, what is going on, everybody? It's TG. We're back with another video. We're going to be talking about how to make money off the meme stocks. I see a lot of you guys trying to make money. You're buying calls, you're buying puts, you're getting IV crush, you're getting theta rocked. We have a solution for that, and I want you guys to watch this video to the end because I show all the different scenarios and how you can profit from this. So obviously, we know GameStop, it's a pretty volatile stock. We like this stock. This is well-known knowledge. If we go and want to make money on GameStop, there's a couple ways we can do it. We can A, buy shares of it at $179.58 a share. We can B, buy a call on it. We can C, buy a put on it if we think it's going to go down. And then we could also sell a naked call, which we don't have enough requirement for that because I tried to do it on my main account today. You need about $300,000 worth of requirement to even sell a $350 strike price call. So that's not an option. Selling a put could be a good idea as well. We're going to talk about the difference between buying calls and buying puts and selling these options and why I think selling it is your best bet. So we look at the option chain right now on GameStop. You're noticing a lot of red. GameStop's only down 2.5% today. These options are down big. If you notice the 200 strike price, which is the most heavily traded one for this week, there's 5,000 open interest. There's already been 1,500 volume on it today. The call is already down 33%, so it's lost a third of its value in one day. Even if we go out to next week, an entire week later, when we go up to the 200 strike price, it's lost a quarter of its value in one day. So I wanted to really talk to you guys about, instead of buying these calls, which could be very profitable if they work out, could also be very detrimental to your account. If we go ahead and actually look at this option and what it entails, there is 142% implied volatility on that. That means this option has to move up a lot in order for you to make money. Also, look at the theta. Theta, if you guys don't know, is how much an option decays every single day. So right now the option's sitting at 898. Let's just say 9 to make it round. It's losing $82 a day. So the next day, that option, you subtract 9 from 82, that's how much your option has left. We're not that good at quick math, so we're not even going to try that. But there's also a lot of other factors about this, and I want to show you guys a great tool that you can use to help you decide whether it's a right time to buy a call or sell a call. So obviously, if you own 100 shares at GameStop and you want to sell a call, you can sell this call and you can make $900 for next week to lose it at 200. A lot of you guys don't want to do that. I totally understand. But let me show you guys what the risks are of buying this call. So this is the exact one we talked about, the 200 strike price, April 16th call. Now, the stock's currently trading at, what is it, 179. So right here. So basically, the second you buy this call, it's almost going to be down. That's just how it is. Usually, unless you get a great bid and ask price instant, but Robinhood doesn't really help you out with that. But let's look at it. So tomorrow, if the stock even goes up 1 point, you're already down $92. Even if the stock goes up 1 point. If the stock stays the same, like right where it is, it's not going to be 176. It's going to be like 150 down. So you're already going to be down $150 on your first day of owning this stock. Now, let's say GameStop does shoot up to 200. Yeah, you doubled your money. That's awesome. So there is a chance of you making big money on this. But if GameStop kind of just stalls out and doesn't really do much, you can see you're losing a lot every single day. After 2 days, you're already down 20%, about 25% after 2 days because it's in the middle of these two. 3 days, you already lost almost over a third of your call. Okay, and then it's going to be really hard for it to shoot all the way up. Even if it does shoot back up there, you're not making nearly as much as you did the first time. So there's a lot of risk. I mean, there's a lot of red on this. There's some green that you can make some big money if it does shoot up big, but you're really risking it, especially if it doesn't happen till late in the week. Let's say next week, on the 14th, it finally shoots up to 200. You're still down 25%, even if it does shoot up to 200. Okay, even if by the end of next week, if it shoots up to 205, you're still down 44%. So that's the issue right there. Is there's so much implied volatility and so much theta. These options, if you're wrong 2, 3, 4 days, you're done. This option's screwed. So what I would recommend, if you want to get into GameStop and you have enough money to sell a put on it, I think selling the put is your best bet. If we go here and we write the same put that we talked about, we go down here. We're gonna be safe. We'll pick a 175, keep it out of the money, just to be even more safe. If we look at this right now, did I do this right? Yeah. So, I mean, as you guys can clearly see, you're not losing much on these. You're not making much either, but you're getting paid $1,323 for the right to buy GameStop at 175. So GameStop would have to drop 5 points in order for you to have to buy these shares. So you get GameStop at a cheaper price, and someone paid you $1,323 to do so. So you guys can clearly see, if GameStop stays above this, you make all that profit at the end. 177, 175, you make $1,300. You make full profit unless it goes under. If it goes down to, 170, you still make 800. 167, the time you start losing money is when it goes to 160. So that's when you start losing money. But as you guys notice, you would have lost a lot more money buying that call or buying the shares upright. This is a great way to buy shares at a cheaper price and to get paid really good money to do so. I mean, look at that implied volatility. You're getting paid a huge premium. And if you guys notice, if GameStop stays flat, like we talked about, look at that. One day, it doesn't do anything, you're up 73, 165, 263, 369, $500 from just staying flat. The stock goes up one day, let's say it goes up to like 185, you're up $450, boom, you can get out right then, lock in a nice profit, or you can just wait until it expires and you get all that premium. So this is a great way to do it. You can also do this on AMC. I know a lot of you guys like AMC stock. If you guys look at AMC, AMC's been kind of trading in a similar pattern to GameStop, but AMC is sitting around $10 exactly right now. So if you want, you go ahead and you write a put for AMC. If you pick the $10 strike price for next week, you get paid $63 per for it. So, that's a pretty good premium. You're putting up $1,000 worth of collateral. You're making $63 on this. You're making like 6.5%. That's pretty good. That's pretty good in my opinion. The same thing goes with AMC. Even if the stock is drops down to, look at this. Look at how far it has to drop down. It has to drop down to 935 in order for you to lose money on this trade. That's crazy. That's a big drop, and if it stays completely flat, you still make all the money. So for you guys, I recommend taking a little dip into Theta Gang. You guys know me on my main account. I'm always doing Theta Gang strategies, and that's how we've been able to build up a 6-figure portfolio because of that. So that's what I recommend to you guys. I really recommend taking advantage of this high implied volatility, because the same thing with AMC, the implied volatility is high. Not as high, but it's still over 100%. Looking at 112% for this week. Next week is going to be about 104%. And you notice that Theta is really high as well. You're losing $3 a day on something that's only $67, $3.50 a day. That's a lot. That adds up. So that's what I recommend to you guys. If you want to make money on these trades, do it in a safe way. Do it in a Theta way. Take advantage of the high implied volatility. If I was super bullish on it, that's what I'd be doing. I would just be selling puts left and right on these companies. So anyways, guys, hope you guys enjoyed this video. Hope it helped you out a little bit and get a better understanding on how you can profit from these Theta strategies. Also, if you don't have enough to actually sell a put outright, you can always do these things called put credit spreads. I love doing put credit spreads. I do it on Apple on my small accounts, and it's a great way to make some profit. You risk $500 in total. We made 208. We're already up $50 on it. Basically, it says that Apple will not go under $120. So our break-in price is $117.92. Obviously, Apple's been flying right now, so we're already up big on that. We're going long term just to make sure we get what we got to get. So, that's my strategy, guys. I love the put credit spreads. I love selling options and getting paid up front. Let me know what your guys' thoughts on that. Your thoughts on GameStop, AMC, all those stocks. I'm really curious to hear. We like the stock. That's just the way it is. So, anyways, guys, have a wonderful day. Make sure you guys like and subscribe, and I will talk to you in the next video. Have a wonderful day. Bye-bye.